In this lecture, I'm just going to explain what is the corporation financial statements and what are the journal entries associated with this. So, by the end of this lecture, that you will be able to understand most important concepts related to the corporation regarding the corporation financial statement, income statement, statement of change in equity, and balance sheet. And what is the meaning of common share and what are the factors which influences the market value of the shares. Now, starting with the financial statement. What is the financial statement? The financial statement for the corporate form of organization are similar to those of the unincorporated businesses like sole proprietorship and partnership. The differences all relate to who owns each form of business organization. Income statement. Corporations are required by law to pay tax because they are a separate legal entity. For example, RJ Corporation is different from RJ Electronics sole proprietorship. In the eye of law, that corporation is considered as a separate legal entity. It means the person who is running the business is separated from its business. For example, Mr. RJ is running corporation, but this is different from the corporation. RJ can get salary or can get a dividend, right, from the profit of the corporation. But at the time of filing a tax return, the corporate tax return will be filed separately and individual tax return will be filed separately, because that in the eye of law, this is a separate legal entity. Now look at this. Assume that income tax expenses for the corporation is 15%. And we have income statement for both. The first one is here RJ Corporation and second one is the RJ Electronics sole proprietor. And there is the difference between these two statements. What are the difference? The major difference is the tax. So look at this. We have a revenue. The same revenue is here minus operating expenses. Then we have a profit from the operations, 4,500 each side in case of RJ Corporation as well as in case of RJ Electronics sole proprietorship. We have other revenue and expenses like gain on sale of capital assets 2000 and same is here. Interest revenue 1000 and 1000 is here, right? And next we have the loss on sale of capital assets, right? So this is a $500 minus and $500 minus is here. Interest expenses minus 200 minus 200 2300. This we have other revenue and expenses in case of both kind of or form of organization. Now come to this point. This is the profit before tax. So it means that whatever the revenue that we have, the 4,500 we have the profit from operation plus this is excess of income over expenditures, means that we have some profit over here, the total profit. So the total will be that here profit from the operations and the profit from the other revenues, then total will be 6,800, right? Here also 6,800. So this is before the profit before tax. So both form of organization have a similar kind of income statement. There is no difference at all. But the only difference is here at the tax part. In the corporation, the tax will be considered as expenses, right? So in this case, expenses of the corporation actually. So in this case, we always look at the net profit after tax. It means the investors, outsiders of the corporation will be looking at the net profit after tax, not net profit before tax. So this is the net profit after tax that we have assumed 50% tax, right? And 15% of 6,800 is 1020, and this is the net profit after tax of 5780. So this is the major difference between the both kind of income statement in the case of corporation and the sole proprietorship. Now, next is the statement of changes in equity. So equity means like share capital, right? So there may be some changes in the equity over a year. Sometimes the company issues shares, sometimes that company retires some shares or buyback. So there may be some fluctuation in that, right? On the basis of that, the equity value of the equity may increase or decrease. Look at this. The equity of the corporation is also changes because of the profit or losses, and the distribution of a profit is known as a dividend and owner's investment. Profit and equity of the corporation can be increased if there is the more profit, because the equity plus profit, right, is equal to the net owner's equity at the end of the period. Profit or loss and dividends are recorded in the retained earning account. So there is a separate account which is created in corporation, but that is not created in the sole proprietorship or partnership. What is that called? That is called a retained earning account. So what is the retained earning? Retained earning means accumulation of a profit minus dividend since the incorporation of the company. Take an example that a company started in 2000 years, right? Before 23 years. Accumulation of a profit, net profit, since 2000 till today means 23 years profit. Every year the profit will be added. Accumulation of profit minus the dividend every year they have paid. The rest of the amount will be retained earning. And that retained earning will be added in the capital, means in the equity, which will be known as the net equity, net share capital. That will be reflecting on the liability side of the balance sheet. While shareholders, which is known as owners, investments are recorded in the capital, share capital account, either common share or preferred share. Now, retained earning represents the profit to date that has been kept, means retained by the corporation for the purpose of reinvestment. The statement of change in equity for a corporation shows how both retained earning and share capital have changed during the accounting period, means from the 1st of January to 31st of December. Now, this is the statement of a change in equity and comparison of the corporation state of a change in the equity, and also that the RJ Electronic, which is the sole proprietorship, and what is the difference in change in the equity. Now look at this. RJ Corporation, the share capital that we have at the beginning 0 and retained earnings 0 and total will be 0. Issue of share capital by the company $30,000, and there will be no any profit at the beginning of the year, so will not be calculated. So it means total equity will be this much. If during the period from 1st of January till 31st of December that there is the profit, right? If there is the profit, that profit will be added in the retained earning account, which you can see here. So profit, for example, 5780 is the profit that we have earned. So this profit is added here. So total will be 5780 less dividend. If there is any dividend, dividend is also a profit. It means the distribution of a profit to the shareholder, that is known as the dividend, right? So the dividend which will be subtracted here, 780 for example, and the rest of the amount of that will be here, right? So the total we can say the share capital was the $30,000, retained earning is $5,000. The total here is $35,000. That is known as RJ Corporation's share capital, right? This is the total net capital at the end of the period. As exactly the same way that, for example, in case of a sole proprietorship, RJ's capital is 0, owner invested 30,000, profit is 6800, and withdrawal is 780. So in this case, we say withdrawal, and in this case, we say dividend. But in the sole proprietorship, there is no any question of any dividend, because that is not a corporation, right? So whenever the money is withdrawn, it is known as withdrawal, right? Withdrawal by the owner for maybe for the personal use. Investment will decrease. Now next, what are the some important points related to the corporation and the sole proprietor? The first one is the distribution of profit. In case of corporation, we say dividend, but in case of sole proprietor, we say withdrawals. Now, investment by the owner. Shareholders are the shareholder invest money, and that is known as share capital, but in this case, that is known as owner's capital. Balance sheet, same, there is no difference at all, but same, except the equity section, means shareholders equity, right? So there will be shareholder equity, but in case of the sole proprietorship, there will be right RJ's capital account, means owner's equity. Now look at the balance sheet. Here, for example, the assets are here and the equity is here. So assets and equity, this is the asset side and of the RJ Corporation. We have here cash, other assets, then the total is this much. Then we have some liabilities, and liability, what are the liabilities we have? So 5200 liabilities, but in equity there is the share capital plus retained earning, and the total is 35780, right? So this is the total equity. Now in this case, the total equity plus a liability, that will be 40980, total liability plus equity, which is equal to the total assets. So total assets is equal to total liabilities. And same is the case here. In case of RJ Electronics sole proprietorship, the cash, other assets, we have the total asset $42,000, liabilities we have RJ capital, and the retained earning is 6800, which is known as the net profit. We can say, instead of writing here retained earning, we can write net profit. So that is the appropriate word in case of sole proprietorship. And here the total equity means owner's equity, that will be this much of amount. So this is the major difference between the financial statement of the corporation as well as of the sole proprietorship. Now if we talk about the issuing of share, issuing share means we can issue share which is known as equity financing. So companies obtain capital or money by issuing shares, and this is referred to equity financing. And share may be sold, right? Issuing means sold, means selling of share. And shares may be sold directly to the investors or may be sold through the brokerage house. If the company only has one class of share, they are known as a common shares. Now, issue of share, look at this. We have here assets and liabilities. RJ Corporation assume that issued the share to the shareholder in exchange of $100,000 cash, and the balance sheet represent for the RJ Corporation immediately after the transaction shows that $100,000 cash having been provided through the equity. So it means the cash, the company has received this much of cash, $100,000, that will come on the asset side of the balance sheet. And on the other side, we will see the liability side. We see that the share capital is $100,000. So assets that is equal to liabilities. So this is at the time of issuing of share that this exactly the same amount will be reflected on the both sides of the balance sheet. Because company has received cash, so assets has increased. This is the current assets, and this is the share capital equity, which is also the same amount. Buying and selling of share. So corporation can sell shares either directly or indirectly to the shareholder at the market value per share. Once the company has issued share, and after then there will be a sale and purchase of share later on, but that will be in the secondary market, right? So to sell share directly, the corporation advertise its share issuance directly to the potential buyer, which is most common with the privately held corporations. So what does it mean? It means that the company can sell share directly to the potential buyer. It means they know who the buyers are, right? Not publicly. If the company is not publicly, right? So that is known as the privately held corporations. That is done by the privately held corporations. They can get money. They can increase capital by issue of shares. To sell share indirectly, a corporation pays a brokerage house, maybe investment bankers, to issue its shares. So what are the different factors influences the market value of the share? Market value per share is the price at which the share is bought or sold, the market value of the share. The market value is influenced by a variety of factors. What are those factors? Number one, expected future earning. If the expected future earning is more good and people have a positive sentiments, definitely the price of the share will go up, otherwise down. What are the dividend? If the company is paying very good dividend every year, it means it will take the faith of the investors. So investor definitely will have faith on that company because the company declare dividend every year, and company declare dividend every year means that company is having profit. The dividend will be given from the profit. If the company is earning profit, if the company is suffering the loss, the dividend cannot be paid. So this is also the second factor. The third one is growth. The company is having one branch and is opening another branch in other province or maybe same province. It means company is growing. And also other company and economic events as well. Buying and selling of shares. The market value of the frequently traded shares are reported online and in daily newspapers such as the Financial Post. We must remember that buying and selling of shares between investors does not impact the corporate equity account that I have explained, because the book value is different from the market value. The book value remains the same. Market value of the share is going to change, maybe up or down. But by buying and selling of the shares, demand and supplies of the share, sentiments of the share, the value of the price has gone up or down, but it's not going to affect the balance sheet. What is the difference between the stock versus share? Sometimes that we can use the stock, sometimes we can share, or sometimes we can say security. But there is no any big difference, but there is a difference in the terminology. What is that? The stock refers to an investor's ownership of the company. For example, you could say, I owe Apple stock, right? In journal, that I owe Apple stock. But share refer to the single unit of the ownership of the company. For example, you could say, I owe 50 shares of Apple Corporation, or you can say, I owe 20% of the shares of the Apple Corporation. So this is the difference between two, but we can use either way. There is no any problem. But technically, and we should know the terminology. So what is a common share? When someone refer to a share in the capital, they are usually referred to as a common share. And those who buy common share will be essentially purchasing share of ownership in the company. Issuing of the common share for non-cash assets. Non-cash matlab means the cash is not coming. RJ Corporation issued 2,000 common share in exchange of land, right? And worth $120,000. So in this case, generally will be land has come in the business, right? This is the assets. Land has increased by $120,000 and the common stock is issued, right? So land account debit to common stock credit. So acquiring land in exchange of 2,000 shares. But if there is the cash, for example, on the other side, if the company has received cash in exchange of the common stock, then the cash account debit instead of land to common stock. That is the main difference for the cash transaction. Look at this. What is the conclusion? What we have learned today? So we have learned the corporation financial statement such as income statement, statement of change in equity, and balance sheet. And what is the meaning of common shares, and what are the different factor influences the market value of the share.